Welcome to my channel. I'm going to show you step by step how to value a stock. The first thing we do is enter the financial information into my discounted cash flow model. We then add the company's debt and equity details to figure out the discount rate. Finally, we determine if the stock is a buy or a sell. We then look at the financial ratios and compare them to its competitors. I'm going to walk you through the entire process so you can do it on your own after watching this video. Make sure to leave a comment if you have any questions. The company we're going to look at is Coca-Cola Consolidated, and this is separate from Coca-Cola. Coca-Cola is trading under the ticker KO. This is trading under the ticker COKE. This company provides all the bottles to the Coca-Cola company. So they are connected, but they're a separate company. They have separate financials. Let's get started with the model. This company has a market cap of $2.5 billion. So that means they're a mid-cap company. Mid-cap has a market cap between $2 and $10 billion. They're trading at $2.69, so that's one share of stock. Let's get to free cash flows. Free cash flow is cash flow from operations minus capital expenditures. And that's how you value a company. You estimate the future free cash flows and discount it back to today's value. That's what we're doing in this video. They have 1 year of negative free cash flows. Let's look at the net income on the income statement. That's the profit and loss for the company. They also have 1 year in net income that's negative. And last, we'll get the sales for each year. And it looks like their sales are increasing every year. And it is possible to have negative free cash flow and positive net income in the same year, and vice versa, positive free cash flow and negative net income. In 2016, they had a $120 million increase in accounts receivables. So when you book accounts receivables, you're selling product, but you're not receiving any cash. You're selling it on credit. So you do book revenue to your income statement, but you're not getting any cash, so your cash flow appears low. That's why maybe they had negative free cash flow in 2016. In future years, when companies pay those receivables, then they may have inflated cash flows in the following years. That's why it's really difficult to look at a company that uses accrual accounting, which is most companies on the stock market, because you have to look at so many years to figure things out. Let's look at the capital structure of the company to figure out the discount rate we need to apply to the future cash flows. The interest they pay on their debt is $46 million. Let's see how much debt they have. We'll go to the balance sheet. Let's go to the liabilities section. And they have no current debt. Long-term debt of $1 billion. That's debt due after 12 months. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. Like I said, accrual accounting makes it difficult because some years they had negative income, yet they paid $1 billion in taxes. So we have to find a year that looks appropriate. It looks like 2016 is best. Income of $92 million and taxes of $36 million. So the effective tax rate is 39%. So the cost of debt is the interest rate on the debt, which is 4.5%, times 1 minus the effective tax rate. So that's 2.7% cost of debt. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. And the beta here is 0.83. So the stock moves less than the market as a whole. So it's a pretty secure and safe stock to invest in. Let's go back to the balance sheet, get their current assets. We need to calculate the current ratio later. And current assets are assets that can be liquidated into cash within 12 months. That's $830 million. And let's see what that is broken down into. $9 million of cash. Net receivables are your total accounts receivables minus the accounts receivables you don't expect to receive. So this gives a more accurate depiction of the receivables, the net receivables. Inventory at $255 million and other current assets at $29 million. Not exactly sure what those are. We need to look at the 10K to figure that out, but they're usually smaller items. That's why they're put into the other bucket. We also need the current liabilities to calculate the current ratio later. That's $622 million. Let's see what that is. That's accounts payable of $187 million. Accounts payable is the money the company owes to its creditors and suppliers. Everything in current liabilities is owed within 12 months. Taxes payable is income taxes the company owes the government of $1.7 million. Accrued liabilities, $168 million. Accrued liabilities is when a company incurs an expense but has not yet paid the expense, so they book it to accrued liabilities. And when they pay that expense, they pull it out of the accrued liabilities and book it onto the income statement. So payroll and payroll taxes are a common accrued liability. And they have $1.2 million of other current liabilities. Let's look at the stockholders' equity. $347 million of stockholders' equity. That's total assets minus total liabilities. And that's broken down into common stock of $13 million, retained earnings of $381 million. So that's good. They have positive retained earnings. Retained earnings is if you sum all the prior year's net income minus all the prior year's dividends. So they're operating profitably. Accumulated other comprehensive income of negative $115 million. This is $115 million of unrealized losses on some of its investments. Unrealized losses are investments that you have not sold yet. You haven't realized a loss. But when they do sell it, they're going to have to book that loss onto the income statement. And companies report unrealized losses on their balance sheet so investors get an accurate depiction of the company's financial health. Let's look at the income statement, get the operating income. Operating income is the money the company earns on its everyday operational business. Now let's look at the capital structure. They have 75% debt. Cost of debt is 2.7%. They have 25% equity. The cost of equity is 8.7%. The WACC is a blend of the cost of debt and cost of equity. That's 4.2%. That's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for, that's $4.5 billion. And these estimates are based off of the prior financial information we input earlier. Now we have to discount these numbers back to today's value. That's in green here. And if we add these numbers up, that's $4.3 billion. That's a value of the company according to the model. We divide that by 9 million shares and we get an intrinsic stock price of $463. So it's trading at $269, so it's trading at a 42% discount. So it's a pretty strong buy according to the model. Let's see what Simply Wall Street says. They're even higher, they're at 805, so they're saying the stock is really undervalued. Let's see what the stock has been trading at. So it looks like it peaked around 370, 380 a few months back, but it's dropped a little. So it seems like it's a really good value because Coca-Cola is always going to be around and they're going to always need their bottles. So this company is going to always be there. So let's look at their financial ratios, see if we get more information. They have a really bad PE, really good price to sales, and a weak price to book. PE is stock price over earnings per share. Earnings per share is net income over shares outstanding. So they have a PE of 220. I like to see below 15. So that means investors are willing to pay $220 for $1 of earnings. This is not a good number of earnings relative to the stock price. Let's look at the price-sales ratio. That's stock price over sales per share. To get sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.5. If a company has under 1 price-to-sales ratio, that's considered an amazing value. They're providing a great value for their revenue relative to their stock price. They just need to convert that revenue to earnings. Price to book of 7.2, which is stock price over book value per share. To get book value per share, that's equity over shares outstanding. I like to see below 3.5. They're a little high for me. Good current ratio and bad ROE. Current ratio is current assets over current liabilities, so they can cover their current debts and payables. ROE is net income over equity. They provide a terrible return to the equity holders, only 3%. They're not bringing in much net income. That's a little concerning. Interest coverage ratio of 4. That's EBIT over interest expense, so they can cover their interest expense 4 times. The best way to look at ratios is to compare them to similar companies. We're going to compare them to Coca-Cola, ticker KO, Pepsi, and this is Coca-Cola Bottling Company. And Coke has a PE much worse than the average. They're the worst in that category. But they do have the best price to sales, price to book, and current ratio, which is really good. Their ROE is terrible because they don't have much earnings. They're the highest in debt, and they're the smallest company by far. So I don't think there's too much risk investing in this company, because if they struggle, the Coca-Cola company, KO, will be there to support them and help them if they need funding. So let me know what you think of the video. Thanks for watching.